Ever wondered how a country's central bank controls and manages the economy? It's all about monetary policy. Monetary policy is essentially the macroeconomic roadmap that a country's central bank follows to navigate the financial landscape. It's the compass they use to ensure they're moving in the right direction, fostering economic prosperity and stability. At its core, monetary policy revolves around managing the money supply, controlling interest rates, and maintaining the overall health of the financial system. It's like the heart of an economy, pumping lifeblood, or in this case money, into the market to keep it vibrant and dynamic. The central bank is the maestro of this symphony, wielding the baton of monetary policy to harmonize the different elements of the economy. It's their responsibility to ensure the music doesn't fall into discord, to prevent the cacophony of inflation, unemployment, and economic stagnation from drowning out the melody of growth and prosperity. In managing the money supply, central banks have a range of tools at their disposal, from open market operations to reserve requirements and discount rates. Think of these as the strings on a guitar, each one able to produce a different note, but all working together to create a cohesive tune. Interest rates are another crucial aspect of monetary policy. By adjusting these rates, central banks can influence borrowing and spending behavior, like a conductor adjusting the tempo to control the pace of the orchestra. And let's not forget the objectives of monetary policy: price stability, full employment, and economic growth. These are the central themes of the composition, the motifs that recur throughout the performance. The goal is to strike the right balance, to make sure no one theme drowns out the others. Finally, remember that every central bank may have a different interpretation of the score. The strategies and tools they use can vary depending on the specific economic circumstances and objectives of their country. So, monetary policy is a powerful tool used by central banks to steer the economy in the right direction. Imagine if you could control how much money is in circulation. That's what central banks do with money supply management. Think of the economy as a giant machine, with gears and levers that need to be adjusted just right to keep everything running smoothly. One of the most significant levers in this machine is the money supply, the total amount of money available in an economy at a particular point in time. Central banks, like the Federal Reserve in the United States or the Bank of England in the United Kingdom, have the power to manage and alter the money supply in their respective countries. They do this by using a variety of tools at their disposal. The first of these tools is open market operations. This involves buying and selling government securities, such as bonds. When a central bank buys these securities, it essentially increases the money supply by creating more money and injecting it into the economy. Conversely, selling securities reduces the money supply by taking money out of circulation. The second tool is reserve requirements. This is the amount of funds that a bank must hold in reserve against specified deposit liabilities. By adjusting this requirement, central banks can influence how much money banks can lend out. A higher reserve requirement means banks can lend less, reducing the money supply, and vice versa. The third tool is the discount rate. This is the interest rate charged by central banks to commercial banks for loans. By manipulating this rate, central banks can influence the amount of money banks can borrow. A lower discount rate encourages borrowing and increases the money supply, while a higher rate does the opposite. These tools, when used effectively, allow central banks to steer the economy, helping to combat inflation or stimulate growth as needed. It's a delicate balancing act that requires careful monitoring and adjustment. So controlling the money supply is a crucial part of monetary policy. How does the price of borrowing money get decided? It's all about interest rate control. Picture this: you're a central bank. Your mandate is to ensure the health and stability of your nation's economy. One of the primary tools you wield is the power to influence interest rates. But how does this work? Interest rates, in essence, are the cost of borrowing money. When you take out a loan, you're not just expected to pay back the original sum, or principal, but also an additional amount, the interest. This interest is essentially the price you pay for the privilege of using someone else's money. Now let's dive into how central banks control these interest rates. Central banks wield a mighty tool known as the policy rate. In the United States, it's called the federal funds rate. This rate is the interest rate that banks charge each other for short-term loans. Central banks can adjust this rate to influence the cost of borrowing money in the economy at large. When the economy is sluggish, central banks might lower the policy rate. This makes borrowing cheaper, which can encourage individuals and businesses to take out loans. They might use these loans to buy a house, start a business, or invest in new equipment, all of which can stimulate economic activity. On the flip side, when the economy is overheating and inflation is a concern, central banks might raise the policy rate. This makes borrowing more expensive, which can discourage excessive spending and help cool down the economy. It's a delicate balancing act. Central banks need to keep an eye on a myriad of factors from employment levels to inflation rates to decide where to set the policy rate. And their decisions can have wide-ranging effects. They can influence everything from the monthly payments on your mortgage to the returns on your retirement savings. So, the next time you hear about the central bank changing interest rates, you'll know exactly what's going on. It's all about steering the economy, encouraging growth when needed, and applying the brakes when things are moving too fast. Interest rate control thus plays a key role in influencing borrowing and spending trends. Inflation and deflation, two enemies of a stable economy. But how do central banks battle them? The answer lies in maintaining price stability, a primary objective of monetary policy. By steering the economy away from the rocky shores of rampant inflation or the icy grip of deflation, central banks help ensure the purchasing power of money remains steady. This stability is vital not just for households and businesses planning their futures, but also for the overall health of the economy. To achieve this, central banks target specific inflation rates, often around 2%. This isn't an arbitrary number, but a sweet spot that allows for modest price increases without causing economic overheating. By adjusting their policy tools, such as interest rates and money supply, central banks can nudge inflation towards this target, maintaining a delicate balance. Maintaining price stability is an essential objective of monetary policy, a bulwark against economic chaos and a beacon of certainty in uncertain times. An economy thrives when its workforce does. How do central banks ensure this? Let's dive into the fascinating world of monetary policy to find out. Central banks play a pivotal role in promoting full employment, which is essentially a state where all who are willing and able to work can find jobs. It's a sweet spot where unemployment is at its natural rate, with no cyclical or deficient demand unemployment. Now, how does a central bank encourage full employment? The answer lies in its ability to influence economic activity through interest rates and money supply. By adjusting these levers, central banks can stimulate or slow down the economy, creating an environment conducive to job creation. For example, when the central bank lowers interest rates, it becomes cheaper for businesses to borrow money. This can lead to increased investment in new projects and expansions, which in turn creates more jobs. But that's not all. Central banks also aim to foster overall economic growth, another crucial aspect of a thriving economy. Economic growth is the increase in an economy's capacity to produce goods and services. It's about creating more and better quality products, improving productivity, and raising living standards. So how does monetary policy come into play here? Well, by maintaining stable financial conditions, central banks aim to support long-term economic expansion. When the financial environment is stable, businesses are more likely to invest in growth, and consumers are more likely to spend, both of which fuel economic growth. Moreover, by managing inflation and keeping it within a target range, central banks ensure that the purchasing power of consumers is not eroded, which supports sustainable economic growth. In essence, monetary policy plays a vital role in promoting job creation and economic expansion. So the next time you hear about a central bank adjusting interest rates or changing the money supply, remember it's not just about numbers. It's about creating an environment where businesses can grow, jobs can be created, and ultimately, where the economy can thrive. In essence, monetary policy plays a vital role in promoting job creation and economic expansion. What happens when a country's currency value fluctuates wildly, and who steps in during financial crises? Let's dive into the world of exchange rate stability and the role of central banks as lenders of last resort. Picture this. When a country's currency value starts to swing like a pendulum, it can wreak havoc on its economy. It affects the prices of imports and exports, making international trade unpredictable and risky. This is where the central bank steps in, wearing the hat of a stabilizer. In countries with flexible exchange rate systems, central banks often intervene in foreign exchange markets to stabilize their currency's value. They can buy or sell their own currency in exchange for foreign currency, affecting the supply and demand balance and consequently, the exchange rate. This helps to maintain a stable environment for international trade and investment. Now let's switch gears and talk about financial crises. Imagine a situation where banks and financial institutions are on the brink of collapse, and there's a looming threat of a systemic meltdown. In these critical moments, who comes to the rescue? Yes, you guessed it, our superhero, the central bank. As the lender of last resort, a central bank provides liquidity to struggling banks and financial institutions. This can be a life-saving injection of money, helping these institutions to meet their short-term obligations and prevent bankruptcy. By doing this, the central bank prevents a domino effect of bank failures, which could lead to a full-blown financial crisis. This role of the central bank helps to maintain confidence in the financial system even in the face of adversity. But remember, with great power comes great responsibility. Central banks need to tread carefully to ensure they don't inadvertently encourage reckless behavior by banks, who might take on excessive risks, knowing they have a safety net to fall back on. Thus, central banks ensure a stable environment for international trade and act as a safety net during crises. Their dual role as stabilizers of exchange rates and lenders of last resort underscores their importance in maintaining economic stability and navigating the choppy waters of financial crises. How do central banks communicate their future plans? And what do they do during times of economic stress? These are questions we often ask when trying to understand the complex world of monetary policy. Two key tools in the central bank's arsenal are forward guidance and quantitative easing, often referred to as QE. Let's start with forward guidance. This is a communication tool used by central banks to provide insights into their future policy actions. Think of it as a weather forecast for the financial market. By providing a forecast of their intentions, central banks can influence market expectations and behavior. They might hint at future interest rate changes or other policy shifts, helping businesses, investors, and consumers plan their financial decisions. The forward guidance helps maintain stability in the financial markets, reducing unpredictability and fostering an environment conducive for growth. Now let's turn to quantitative easing, a term that became a household name during the global financial crisis of 2008. When conventional monetary policy tools like lowering interest rates are insufficient to stimulate the economy, central banks turn to QE. It involves the central bank purchasing large amounts of financial assets, typically government bonds, from commercial banks and other financial institutions. This influx of money increases the excess reserves of the banks, encouraging them to lend more, thereby injecting liquidity into the economy. The increased supply of money aims to lower long-term interest rates, boost investment and spending, and ultimately stimulate economic growth. These purchases are not limited to government bonds. They can include other assets like corporate bonds or asset-backed securities to support specific sectors of the economy. The goal remains the same: to increase liquidity and stimulate economic activity. It's important to note that both forward guidance and QE are not without their potential risks and criticisms. They are powerful tools that must be used wisely and judiciously to navigate the delicate balancing act that is monetary policy. In conclusion, forward guidance and QE are tools used by central banks to manage market expectations and inject liquidity into the economy. Why do central banks operate independently from the government? Let's find out. The independence of central banks is a cornerstone of modern monetary policy. This independence is not just a matter of tradition or convention. Rather, it's a crucial aspect that helps maintain long-term economic stability. But why exactly is this the case? To answer this question, we need to understand that the goals of a government and those of a central bank can sometimes diverge. Governments, being political entities, may be inclined towards policies that yield short-term benefits, but could potentially harm the economy in the long run. For instance, a government might be tempted to stimulate the economy and lower unemployment before an election, even at the risk of causing inflation. On the other hand, central banks are primarily concerned with long-term economic stability. They aim to maintain low and stable inflation and foster sustainable economic growth. These objectives require a longer-term perspective and may sometimes necessitate making decisions that are politically unpopular in the short term. That's where the independence of central banks comes in. By operating independently from the government, central banks can resist political pressures and make decisions based on what's best for the economy in the long run. They can adjust interest rates, manage the money supply, and implement other monetary policies without fear of political backlash. This independence also helps central banks maintain their credibility. If the public and financial markets believe that a central bank is free from political interference and is committed to its objectives, they are more likely to have confidence in the bank's policies. This confidence can make monetary policy more effective, as it influences people's expectations and behaviors. However, it's important to note that independence doesn't mean a lack of accountability. Central banks are typically required to explain their decisions and actions to the public and their respective governments. They also have to abide by certain rules and targets which help ensure that they act in the best interest of the economy. Hence, an independent central bank can focus on economic stability, free from short-term political considerations.